Jennifer bought Tesla stock at $380 in November 2021. She'd read articles calling it the next Apple. She'd watched YouTube videos promising tenfold returns. She invested her entire retirement savings, $127,000 accumulated over 15 years of careful budgeting. By December 2022, her investment was worth $31,000. She'd lost 76% of her life savings in 13 months. Jennifer made the same mistake that destroys more wealth than market crashes, more than inflation, more than any single economic disaster. She followed the crowd at exactly the wrong time. She confused popularity with profitability. She mistook momentum for value. And in 2026, millions more will make the same mistake. The difference is that 2026 won't offer the luxury of recovery time. The economic environment ahead combines the worst aspects of 1929, 1973, and 2008 into a perfect storm that will obliterate traditional investment approaches. The strategies that worked for the past decade will become wealth destruction machines. But the warning signs are visible now. The mistakes are predictable, and the people who recognize these patterns can position themselves to survive what's coming, while others lose everything. Most investors approach 2026 with strategies designed for an economy that no longer exists. They're fighting the last war, while the next one has already begun. They're making decisions based on historical patterns that have been permanently broken by unprecedented debt, demographic collapse, and monetary desperation. Here are the 3 mistakes that will separate survivors from victims in the coming crisis. Each one seems logical. Each one feels safe. Each one will destroy you if you're not prepared. Mistake number 1. Trusting the everything bubble to continue. The first mistake is believing that asset prices will keep rising indefinitely simply because they have for the past 15 years. This isn't optimism, it's mathematical impossibility disguised as investment strategy. Since 2009, the Federal Reserve has printed over $8 trillion while keeping interest rates near zero for 14 years. This artificial money creation inflated every asset class simultaneously. Stocks, bonds, real estate, crypto, art, collectibles, everything became expensive because everything was priced in newly created dollars. But here's what most investors missed. This wasn't a bull market based on economic growth. This was a currency debasement event that lifted asset prices while destroying purchasing power. The assets didn't become more valuable. The dollars measuring them became less valuable. Walk through any American city and you'll see the evidence. Houses that sold for $200,000 in 2010 now cost $600,000. The houses didn't triple in quality or functionality. The dollars measuring them lost 2/3 of their purchasing power relative to hard assets. The same pattern infected every market. Companies with no profits achieved billion-dollar valuations. Bonds paying 1% interest traded at premium prices. Cryptocurrencies with no utility reached trillion-dollar market caps. Art pieces sold for hundreds of millions to buyers who couldn't explain why. This created a generation of investors who confused monetary inflation with investment genius. They bought rising assets and called themselves smart. They ignored fundamentals and focused on price action. They developed strategies based on the assumption that central banks would always prevent major declines. But the everything bubble has reached mathematical limits. When the Federal Reserve owns 25% of the bond market, they can't buy much more without destroying the currency entirely. When government debt consumes 100% of tax revenue for interest payments alone, they can't borrow much more without triggering hyperinflation. When asset prices exceed the economy's ability to support them, something has to break. In 2026, that something is breaking. Bond yields are rising, despite Fed cuts. Stock valuations are collapsing, despite corporate buybacks. Real estate is freezing, despite mortgage manipulation. The artificial supports are failing because the underlying economy can't sustain artificial prices. Investors who built wealth during the bubble years face a cruel choice. Sell assets at declining prices to preserve capital, or hold assets through a deflationary collapse that could destroy 60 to 80% of their value. The smart money already made this choice. Warren Buffett's Berkshire Hathaway holds $325 billion in cash, despite endless criticism for missing opportunities. They're not missing opportunities. They're avoiding the trap that will destroy everyone else. But average investors remain trapped in the bubble mentality. They see every decline as a buying opportunity. They interpret every rally as confirmation that the bull market continues. They dollar-cost average into falling assets while their portfolios evaporate. This mistake destroyed Japanese investors in the 1990s when their everything bubble collapsed. It destroyed dot-com investors in 2000 when technology euphoria ended. It destroyed housing investors in 2007 when subprime mortgages imploded. The pattern is always the same. Assets become disconnected from underlying value. Investors mistake artificial demand for permanent demand. And when the artificial support ends, prices collapse toward fundamental worth. The difference in 2026 is that the bubble encompasses everything simultaneously. There's no sector rotation possible when every sector is overvalued. There's no geographic diversification available when every major economy faces the same debt crisis. There's no currency hedge effective when all major currencies are being debased. Investors who recognize this reality can prepare by holding assets that maintain value during currency debasement, while avoiding assets that depend on continued monetary expansion. Those who don't recognize it will experience wealth destruction that makes 2008 look gentle. Mistake number 2. Fighting the Fed when they're actually serious this time. The second devastating mistake involves misunderstanding the Federal Reserve's actual position in 2026. For 15 years, investors learned a simple rule: don't fight the Fed. When the Fed cut rates or printed money, you bought risk assets. When they talked tough about inflation, you ignored them because they always reversed course. This strategy worked perfectly from 2009 to 2021 because the Fed's primary concern was preventing deflation and supporting asset prices. Every market decline triggered immediate intervention. Every economic slowdown produced stimulus. Investors learned to buy every dip because the Fed would rescue them. But 2026 represents a fundamental change in Federal Reserve priorities that most investors haven't recognized. The Fed's credibility is under existential threat. Inflation has destroyed their reputation. Foreign central banks are dumping treasury bonds. The dollar's reserve currency status faces its first serious challenge since World War II. For the first time in decades, the Federal Reserve faces a choice between saving the currency or saving asset prices. They can't do both. Saving asset prices requires more money printing, which would accelerate dollar destruction. Saving the currency requires allowing asset prices to fall to levels the economy can actually support. The Fed has chosen the currency. This represents the most significant policy shift since Paul Volcker's inflation fight in the 1980s, but today's context is far more dangerous. In 1980, America was the world's largest creditor nation with manageable debt levels. In 2026, America is the world's largest debtor nation, with debt levels that make fiscal responsibility impossible. But investors haven't adjusted their strategies to reflect this new reality. They're still buying every dip, expecting Fed rescue operations that aren't coming. They're still leveraging their portfolios, assuming backstops that have been removed. They're still ignoring fundamental analysis, believing that monetary policy trumps everything else. This mistake is already destroying portfolios in real time. Bond investors who expected rate cuts got rate holds. Stock investors who expected quantitative easing got quantitative tightening. Real estate investors who expected mortgage support got mortgage restriction. The Federal Reserve's actions in late 2025 and early 2026 have sent clear signals that previous policies are finished. They've allowed regional banks to fail without bailouts. They've permitted corporate bond defaults without intervention. They've watched stock market declines without emergency stimulus. Each of these events represents a clear break from 15 years of Fed put policies. Yet investors continue operating under old assumptions. They interpret every Fed statement as secret code for eventual accommodation. They view every policy hold as temporary posturing before inevitable reversal. This misunderstanding will prove catastrophic because it leads to exactly wrong positioning for the actual environment. Investors are leveraged for continued monetary expansion when they should be positioned for monetary contraction. They're concentrated in growth assets when they should own value assets. They're exposed to long-duration risks when they should hold short-duration hedges. The evidence of Fed seriousness is overwhelming for those willing to see it. Foreign policy coordination shows international pressure to defend the dollar. Treasury cooperation demonstrates fiscal recognition of monetary constraints. Congressional hearings reveal political understanding that credibility matters more than asset prices. But the majority of investors remain committed to strategies that depend on Fed accommodation that isn't coming. They're fighting a Fed that has fundamentally changed its priorities, and they're losing badly. The tragic irony is that this mistake is self-reinforcing. As more investors lose money fighting the Fed, political pressure builds for rescue operations that would destroy Fed credibility entirely. The Fed must choose between short-term market stability and long-term currency survival. They've chosen currency survival, which means temporary market instability becomes permanent for those who don't adjust. Mistake number 3. Ignoring the Great Rotation. Out-of-paper assets. The third and most devastating mistake involves missing the largest capital allocation shift in modern history. While American investors debate stock valuations and bond yields, the rest of the world is quietly abandoning paper assets denominated in any Western currency. This isn't market timing or tactical allocation. This is a strategic reallocation of global wealth toward hard assets, productive capacity, and tangible resources. It's happening in real time, but most Western investors don't recognize it because their information sources focus on domestic markets rather than global capital flows. The rotation began in 2022, when Russia's dollar reserves were frozen. Every non-Western central bank received a clear message. Paper assets can be confiscated instantly for political reasons. Your wealth isn't secure unless you control it directly. Foreign governments that spent decades accumulating treasury bonds suddenly understood that those bonds represented political leverage over them, rather than financial assets for them. The response was immediate and systematic. China, Russia, India, Saudi Arabia, Brazil, and dozens of smaller nations began converting paper reserves into gold, oil, strategic metals, agricultural land, and industrial capacity. They stopped recycling trade surpluses into Western financial markets and started investing in infrastructure, resources, and production capacity within their own territories. This capital rotation is massive in scale and accelerating in speed. In 2023, central banks purchased over 1,000 tons of gold, the largest purchases since 1967. In 2024, foreign treasury holdings dropped by the largest amount since records began. In 2025, direct investment in commodities and resources exceeded financial investment for the first time in 40 years. But Western investors largely ignored these developments because their portfolios continued rising on central bank liquidity and corporate buybacks. They assumed foreign selling was temporary and that buyers would return when prices dropped. They misunderstood a structural shift as a cyclical adjustment. The reality is that the Great Rotation represents a permanent change in global wealth allocation patterns. Countries that produce goods are keeping the wealth instead of lending it back to countries that consume goods. Oil producers are investing in renewable energy rather than financing oil consumers. Agricultural exporters are building food security rather than financing food importers. This shift has profound implications for asset prices in Western markets. When foreign central banks were automatically buying treasury bonds with their trade surpluses, bond yields stayed artificially low, regardless of fiscal policy. When sovereign wealth funds were investing in Western stock markets, valuations stayed artificially high, regardless of economic fundamentals. That automatic buying has stopped. In many cases, it's reversed into active selling. The artificial demand that supported Western asset prices for decades is disappearing, just as Western governments need more borrowing than ever before. The mathematical consequences are inescapable. When demand drops and supply increases, prices fall. When foreign buyers disappear and domestic debt issuance accelerates, yields rise. When investment flows reverse from west to east toward east to east, Western assets become overvalued relative to Eastern assets. American investors who understand this rotation can position themselves accordingly by owning assets that benefit from global reindustrialization rather than assets that depend on financial engineering. International diversification means investing in productive capacity where it's actually located, rather than where it's financially traded. But the majority of American investors remain concentrated in domestic paper assets that depend on foreign demand that isn't returning. They own shares in companies that consume resources, rather than companies that produce resources. They hold bonds issued by governments that borrow, rather than governments that save. This concentration will prove devastating as the rotation accelerates throughout 2026 and beyond. Assets that performed well when foreign capital was flowing into Western markets will underperform dramatically when that capital flows toward productive investments in growing economies. The Great Rotation isn't temporary market volatility, it's a permanent restructuring of global capital allocation that reflects changing economic realities. Western economies are aging, indebted, and consumption-focused. Eastern economies are young, savings-oriented, and production-focused. Capital follows productivity, and productivity has shifted eastward. Investors who recognize this shift and position accordingly will participate in the greatest wealth transfer in human history. Those who ignore it will find themselves holding expensive claims on declining economic systems while missing the growth happening elsewhere. The 2026 Convergence, when all three mistakes combine. These three mistakes don't operate independently. They compound each other in ways that amplify losses beyond what any single error would produce. Investors who trust bubble prices while fighting the Fed, while ignoring global rotation, face simultaneous destruction from multiple directions. The everything bubble collapses, just as Fed support disappears, just as foreign buying vanishes. Asset prices fall toward fundamental values, just as monetary policy tightens. Just as global capital flees toward hard assets. Leveraged portfolios face margin calls. Just as central banks prioritize currency stability. Just as international diversification becomes impossible within traditional frameworks. This convergence explains why 2026 feels different from previous market difficulties. The standard playbook, buy the dip, wait for Fed rescue, assume foreign demand continues, fails because all three assumptions have become invalid simultaneously. But convergence also creates opportunity for those who understand what's happening. While others lose wealth through obsolete strategies, informed investors can position themselves to benefit from each transition. They can own hard assets during bubble collapse. They can be unleveraged during Fed tightening. They can be internationally positioned during capital rotation. The key insight is that these aren't three separate problems requiring three separate solutions. They're three aspects of the same historical transition: the end of dollar hegemony and the beginning of a multipolar financial system. Investors who understand this transition can navigate it successfully. Those who don't will discover that 2026 marks the year when traditional American investment strategies stopped working permanently. The choice is simple: adapt to the new reality or become a casualty of historical change. The three mistakes are visible now. The convergence is accelerating. The opportunity remains available for those bold enough to break from conventional wisdom and position themselves for the world that's actually emerging rather than the world that's disappearing. But time is running short. The longer investors wait to recognize these realities, the fewer options they'll have for protecting and growing their wealth through the transformation ahead. In 2026, investment success won't come from following traditional advice or conventional strategies. It will come from understanding what's actually happening beneath the surface of market movements and positioning accordingly before the majority figures it out. The three mistakes are already destroying portfolios. Don't let yours be next.